Today's topic is going to be about commercial mortgage financing. So most people are familiar with single-family financing or residential, which is 4 units and below. You can go to any bank and see if you qualify based on your income to get a 30-year mortgage. It's pretty standard across the single-family industry. Once you start getting the commercial loans, it gets a little bit different. You could still have a 30-year amortization, but the big thing in commercial loans is they have balloon payments. So if you get a 5-year term or a 10-year term, your payment schedule will still be based on 30 years, but you will have to pay the full balance at the end of that balloon term. So
there is a balloon.
Yeah.
It's not fully amortizing. I think some people realize that or don't realize that hey, there's a balloon at the end of this thing. But keep going.
Yeah. So typical standard terms in commercial loans are 3 years, 5 years, 7 years, 10 years. Very little people do 12 years, and then you can actually do, if you get a bank loan, you can get 30 or 25 year.
Yeah, 25-year fully amortizing. Yeah.
So there's also different types of commercial mortgages. You have traditional bank loan, you have an agency loan, which there's 2 main agencies that lend, Fannie Mae and Freddie Mac, and then you have private debt funds all across the country that will also lend on a short-term basis on your property. Kind of break down the different loan types.
Yeah, I mean, so if you're first getting started, most people, I would say 2012, 13, 14, a lot of bank loans were done. So bank loans were 25% down, usually 3 to 5 years, and it would be full recourse to you. So if you ended up giving back the property and you were short, there was a deficit, your balance sheet was at risk, they could come after you. And most of those deals they did fine because the market was doing well, and then they made you put in close to 25% of the 25% of the equity had to be you, the sponsor. And so that's where most people start out, smaller deals. And on the bank loan side, I would say max probably 10 million is where that sort of caps out, and then maybe get into Freddie SBL.
Yeah, the next kind of loan type moving up from the bank recourse is the Freddie SBL or small balance loan, 1 million to 7.5 million. That one's non-recourse. A lot of commercial investors like non-recourse, so no balance sheet liability. You don't necessarily need a lot of experience to get that. It's for newer investors. It's kind of a way for them to get into the market, get a smaller property, 1 to 75 units. 75 units and under, and then go full cycle on that, and then start working their way up to bigger loans.
The big boys.
The big boy loans, yeah.
Conventional Fannie and Freddie. So conventional Fannie and Freddie usually starts for Freddie Mac, it starts at 7.5. For Fannie, really starts around 6 million. Those are really the bigger loans. Similar structure. They want occupancy 90 for 90. 90% for the last 90 days. They want 125 debt service coverage, and then they want you to have experience. So you need to have, somebody asked me last week, hey, I did like a mobile home park, or I did some, office or retail. Does that count as sort of my gold card for agency? It's like, no, they want actual experience, ownership. You're the GP, and I've heard rumors of this, but it's almost like, some people, they've even asked for the operating agreements of the stuff on your SREO. So they're digging in pretty deep to make sure that you're actually the manager, you're actually in control of these deals. And so that's the next level. And then maybe wrap up with the non-recourse bridge.
Yeah, the non-recourse bridge really became popular in 2021 and 22. Originally, bridge financing is like a bridge to the agency, or the permanent financing they call it in commercial. So if a property is below 90%, we toured some properties today that were below 90% occupied. So they would get a bridge loan and then get the property leased up, occupied above 90%, and then refinance into the agency loan. But yeah, it's more short-term basis, usually floating. I've done some fixed before, but typically people go floating, get a rate cap for 2 to 3 years, and then try to refi. But you have to hit your projections. Otherwise, you can get stuck and have trouble cash out refining like we've been seeing the last year.
So we're not to the level of aggressiveness so in 21 and 22, what happened was interest rates dropped. So you remember, like in 21, your savings account was paying 0.0001%. So basically you didn't notice that penny hitting your account in interest. And so investors, they were getting no yield anywhere. And so if they bought a 10-year treasury, you got 50 basis points on a 10-year treasury. So they're like, look, we need some sort of yield. And they were saying, all right, first mortgage against multi, and you get 4%, sign me up. And so people backed up the truck. And so January of 21, so many bridge lenders came into the space that they could originate the loan and then securitize it, and it was being bought so quickly. So that was 21, 22.
Yeah, get that 4 or 5%.
Yeah, because you could buy a U.S. Treasury at under 1%, or you could buy this bridge note at 4%. Oh, sign me up, I'll take the 4%. And what happened with that, there's so much competition, so many lenders, that the underwriting standards went down, and then the LTV kept going up, pricing went down. And I'm not saying we're back to that craziness, but the amount of money that bridge lenders have to put out right now in 25 is also increasing, right? And the competition is increasing. So before, maybe in 23 and even 24, you maybe get 2 or 3 quotes from bridge lenders. Right now you can maybe go get 7 or 8. And so what's going to happen is there's going to be a lot of competition for these loans. And right now they're saying, what do they want? They want A class with an A borrower. And so it's a race to the bottom in terms of interest rate, but then not everybody's going to win that deal. So I think we're going to start seeing those bridge guys roll into more the B stuff and maybe even the C stuff eventually. So